Hey guys, let us start our Forex market analysis session. I have two trading opportunities for you that were found by the MPS5 pattern recognition software. They are Canadian yen and dollar yen 1 hour time frames. Other pairs have no patterns at all. So what are these possibilities? What are these opportunities? They are type 2 reversals. Both of these trades are type 2 reversals. We had initial bounce, it is called a type 1 reversal. It seldom goes to 61A, but it is minimum 382 at least. 382. This is what we call a type 1 reversal. And then what price does, it goes to retest that reversal area after that. And typically it provides a much greater reversal that exceed the 61A. Okay, so this is number one opportunity, and number two opportunity is dollar yen. It is the same opportunity, similar opportunity. We have the type 1 bounce to 382, then we had another bounce that didn't reach the 382, but it is the beginning of type 2 reversal. And typically when we have situations of type 2 reversal, we also have some patterns as well. So if I use my manual tool to draw some minor patterns, we will see that we have a small pattern here as well. Okay, so these are the two opportunities. As for the execution, let's just talk about this common execution rules, what you should look for, and to draw it I will use it this way. First of all, let's draw the pattern. Let me use the color of the pattern. What is the color? Blue color will be okay. Okay, here's the pattern like this. I will use a unified Gartley, but it is okay for a cipher as well. It doesn't matter. Basically, the pattern is a means for calculating support and resistance. So we have this zone between the completion of the level of the pattern and invalidation level of the pattern. Between these two, we have a valid support zone, and it will be very nice if it coincides with some old structure to the left. Okay, so what you need to do, you need to look at the price section, especially the bodies of the candles. The bodies of the candles, they should lose momentum while approaching your level. Let me put this color green. So yes, imagine we have some green candles like this. We have great green candle, we have smaller, the body of this candle, then we have smaller, then we have smaller candle, then we have even smaller candle, and wicks, we can have some wicks of this candle, and then we have almost non-existent candle, something of this kind. And after that we may have a large expansion bar. It happens seldom, but it is not. I will talk about this a bit later. Okay, so we may have it this way, and after that, what is the ideal thing is that we have a red candle with the body greater than the previous green candle, followed by another red candle with the body greater than the previous one. So what we would like to see here is while price is approaching, moving to the downside, yes, the bodies become smaller and smaller and smaller, so the momentum fades, and while price moves to the downside, the momentum rises. Okay, I created the special momentum indicator. It calculates the difference of bodies. If the body is greater, it draws the green histogram. If the body is smaller than the previous one, it draws the red histogram, so it looks this way. I will zoom it in a second. So the first thing you need to understand that the bodies of the candle should become smaller and smaller and smaller, and the ideal reversal is this. Just wait for two green candles with rising momentum or rising bodies. The first one should be greater than the previous, and the second one should be greater than the previous as well. Another type of this reversal can happen this way. Another situation when you have the reversal, it can happen this way. So after these small candles, we may have a number of these candles. Like this. Yes, they may be green and they may be red, and they may be moving sideways, and then you have a large expansion bar to the upside, followed by immediate reversal candles, and these immediate reversal candles cancel all that progress. So what we have here, we have the expansion of your momentum to the upside. This is called the climax. So we were fading here, and guys understood that the continuation will not go to the upside, and they do the climax. They push prices higher to execute at better prices. So we have this climax that doesn't have a follow through. What is a follow through? A follow through will be this, like this. Don't miss. A follow through is this. A candle greater than previous one is the follow through. So the momentum is rising. This is a follow through. But if you have a red candle, it is not a follow through. It is a reversal, and the previous one was a climax. And wait for the second candle, and the momentum should be rising. So on your indicator, downside indicator, you will have this. You will have decreasing momentum, then you will have some spike to the upside like this, and then you have increasing momentum in opposite direction. Okay, so this is the execution. So wait for two. You can execute at market, or you can wait for a pullback. I typically wait for a pullback to 50%, somewhere here, 50%, and then I enter short. It gives me a very nice entry. So these climax patterns typically draw minor head and shoulders patterns. So these climax patterns, or you just have a simple reversal that I discussed previously. So these are the two opportunities, not the opportunities, the two most common reversals. Also, we can have a very sharp reversal, yes, and you cannot get into that because you don't have that pullback. Price immediately moves to the downside. That's why sometimes it is better to enter at market as soon as the candle closes. Sometimes it is better to wait for a pullback, but you never know if the pullback will present or if it won't. That's why you should either execute consistently one method, or you should execute consistently another method. You either enter consistently with at market orders, or you enter consistently with pullback entries. Okay, hope you understood the entry. What is about the stop loss? I typically place my stop loss. For example, I entered here, yes, I just place it 3 ATR above my entry. It may be below invalidated level, or sometimes it is above my invalidated level. It depends, but it is my 3 ATR buffer. When I enter, I give the 3 ATR buffer to the market to provide a valid reversal. If during the 3 ATR period we didn't get any reversal, this means that I was wrong. I just get out. I also split this buffer into thirds. like this. So one ATR, one ATR, one ATR, and I also add here one ATR, one ATR, one ATR, and so on. So if price moves and hits one ATR, yes, I put my stop loss here. I cut my loss. Yes, if price moves further to the second ATR, I cut my loss further. If price moves further to the third ATR, I break even my trade, and so on and so forth. Basically, it is one ATR trailing, not one ATR, but 3 ATR trailing stop, because between the price and stop loss, you have the 3 ATR distance. Very, very convenient to trail it this way. And in case price made some bounce to the downside and changed its mind, you either exit break even, or you have your loss less than the initial risk. This is very important if to cut your losses. Okay, this is about the execution. Now let's examine this real market situations. So what do we have here? There are two levels here for price to bounce. It is the 786 level, basically looks like support, consolidation, support, almost support of this level, and finally it was broken. So what I want you to pay attention is the price action here. Let me zoom it in and more. Okay, so let me move it here. So look at the price action while it moves to the downside and when it moves to the upside. When price action is moving to the downside, we should have the acceleration, especially here. We started from this small candle body, yes, and then we have larger and larger bodies on this segment. You see that? And after that we have smaller bodies. Then we have expansion to the upside like this. Then we had that kind of retracement. All retracements typically, the retracements should be fading momentum. They should not give you a very large momentum. Yes, and then we have expansion to the downside. Yes, price hesitated a bit here at this candle. You see, that's why we have fading momentum. But then the momentum to the upside began to rise at this candle. So the momentum began to rise and we have greater momentum. That's not enough for me to initiate the trade. It is simply analysis. After that we have this correction momentum. It is sideways to the downside, doesn't matter. None of the sides of the market win the battle. And then momentum expands to the upside here. We have it this way. Okay, after that the momentum fades. We have that drifting price. And finally it expands to the downside. Candle, greater and greater candle. So it expands lower. When we have this expanding momentum breaking this level, most likely we have a breakout. Most likely. And look at the immediate candles after that. We didn't have the follow through, we didn't have the immediate continuation to the downside, but we also didn't have a bounce to the upside. We have this small momentum candles here. So you can see how the power increases to the downside. You could sell it from here or you could buy it from here. Although here it is a disputable situation, I wouldn't buy it from here. I would wait for some more clearer signals at this level, because the momentum of this candle was not greater than the previous one. This is the only reason why I didn't buy it. And let me disable it. Let me go here. So what we had at this candle, we tried to bounce to the upside. We tried to install an impulse to the upside, but it was not an impulse because momentum was fading. So the movement to the downside was rising momentum, and movement to the upside was fading. That's why it is only a correction. You see that? Well, on individual candles it can slightly mismatch that, but you should look at the picture as a whole. After that we have drifting price action. Neither of sides of the market can take, neither of the side takes active actions, I'd put it this way. So even if we bounce to the upside, we don't have anything for here. When we bounce to the downside, we also don't have anything of rising momentum, something of this kind. But what we have a rising momentum here, and then we have decreasing momentum on the upside, then we have a rising momentum on the downside, and it signals to me that we will most likely, this is a correction because we move to the downside, most likely we will break that level. We will break this level, most likely. And another confirmation for me is the number of touches. We touched that 1, 2, 3, 4, 5, 6, 7 times we bounced, and this is number 8 that we try to break this level. Typically it is said that if price touches some level more than 3 times, it will break the level. Okay, so you should keep this in mind, that this pattern now provides a continuation opportunity rather than a reversal opportunity. So you see that? We should have a bounce to the upside, but it didn't happen. Price action installs something opposite to our expectation. This means that we should adjust our beliefs to the market situation and consider selling of this pair. Okay, on Canadian yen it is even more obvious. Very great rising momentum to the upside. So we move lower, and here we move higher, like this. Very clear situation of a breakout. Wait for the candle to close, 8 minutes left. It may leave a very long tail and close higher, and it will be a very good signal for a reversal, but you should wait until it closes. Okay, both of these patterns provide a continuation. For now, what we have for this moment, it provides a continuation rather than a reversal. Okay, consider selling these pairs. If they come to retest or whatever, maybe they will retest that level. Well, if you like this video, give me your thumbs up, share this video on social media. If you find it useful, type your comments. Until then, good luck and good trading. Hope to see you soon.